Hey everyone, hope everyone's doing well. This is the overview of the Emini 5-minute chart for Friday, September 27th, 2024. So today is Friday, so if we look at the weekly chart first, this is last week, and you can see the market is at the top of a trading range. Is it a bull channel? You can argue. We're still getting higher lows and higher highs, but this bear breakout was strong enough to convince a lot of traders that we fell below this higher low, which was a major higher low. And because of that, at this point, the market is either in a trading range or a bear trend, but no longer a bull trend. So at this point, the market is trying to break out of this swing high and possibly break into a new bull trend. But the problem is that 80% of breakouts of trading ranges fail. And look at the breakout. Big down, big up, big down, big up. We have a bull trend bar, but it's an inside bar. And then we have a follow-through bar, but the follow-through bar is a lot smaller than this bar. And even though it's a trend bar, it's not really a breakout bar. It's an inside bar, so it's a non-breakout bar. And inside bars typically get retested within a couple of bars. So the expectation, probably sellers above. And coming into today on the weekly chart, obviously we had a more bearish day today. So the weekly chart was closing somewhere up here. And because it's Friday, the bears are going to do everything they can to change the appearance of the bar in the final day, the final 20% of the bar. You may have noticed that on any other chart, any other time frame, when you're watching the 5-minute chart, and you'll notice in the final minute of a bar, the final 20% of the bar, you'll often see something drastic happen that really changes the appearance of the bar, and that's common. And because markets are fractal, that happens on every chart. So the final 20% of the weekly chart is Friday. So we were above the midpoint of the bar at the beginning of today, and you can see the bears did a good job making this bar sell off and close below its midpoint. On the daily chart, we've had a lot of trading range price action. Here, we're at the top of a big trading range. We're at the top of a small trading range. This was yesterday. It's a reversal bar, but bear body, bad buy signal bar, probably sellers above, maybe even sellers on the close. The upside probably limited, probably going to test lower, and it's possible we get vacuumed down to the moving average, because if traders are buying this far above the moving average, their premise has to be that they're buying momentum, because you're not buying value when the market is this far above the average price. So if you're buying momentum, and maybe you make an argument for it here, how are you feeling when the market starts doing this and you're going sideways, and one day goes by, another day goes by, and the market is sideways? It's not really momentum at that point. So more and more traders might start to sell, and that could cause a vacuum effect, and we could get sucked down to some support. On the 5-minute today, let me just draw. Here's yesterday's high and yesterday's low. The reason I draw these, most bars break out of the prior bar. Only maybe 10% of bars are inside bars, which are non-breakout bars. So if most bars break out and markets are fractal, then it happens on the daily chart too. So there's a high probability that the market breaks out either above the high or below the low of the prior day. And those are often, support or resistance areas. So bar one, we gapped up coming into the day, and we had this midday reversal yesterday. Pretty decent rally. We have open gaps. Went sideways here, but became a bull flag. We're breaking to the upside. Bar one's a doji. We're expecting trading range price action on the open. 80% of days have trading ranges on the open. Maybe we're at the top of a bull channel, and you can argue 1, 2, 3 pushes up, but not great selling pressure through here. So probably not many traders selling below 1. If anything, they're probably buying below 1, scaling in lower. We're probably always in long, but there's a risk that we have big down, big up, and this bull trend is just a leg in a trading range, and we're getting high in the range. Also keep in mind, we have traders trapped over here. If a trader bought above bar 6 yesterday, they were trapped on bar 7, and the market never gave them a chance to exit at break even. We never retested that price for that stop order. So this horizontal red line might be resistance. Bar 2, we have a bear breakout bar, but breaking out below a trading range bar, probably buyers below, scaling in lower. It's a good bar, but a lot of overlap, and maybe only 10% of the bar is actually breaking out below the prior bar. So too much overlap might be a sell vacuum in a trading range, and if that's the case, we might just get bad follow through. Bar 3, more overlap and bad follow through. You can see we're going sideways. And then we got bar 6, or you could say bar 5. We have a micro double bottom, implied reversal on bar 3, continuation, and then reversal above bar 5. Now we're bull bar closing above its midpoint, bull reversal bar on 6. After the gap up, retesting prices to the left where traders were trapped. Let's say a trader sold above bar 81, betting it's a bad stop order buy, and they were trapped. The market comes back, and you can see there's buyers at that price. The gap up, strong enough breakout for a second leg. Plus the market is still in a bull channel. But like I said earlier, the upside might be limited. This might be an overall trading range. And the higher we get in the range, the more dangerous it is to be buying. 7, surprise bar. It's often the case that bar 7 is a report bar. And there was news today. And that's really common. And it's not important to know what the news was. It's really just important to know that there is a report and you can get some volatility out of it, some range expansion. So we had an outside up bar. Any trader who sold below bar 6 was trapped on bar 7. Bar 7 likely to get a second leg up, and the low of 6 probably will be support. Inside bar on bar 8. Now we have an IOI, which is a breakout mode pattern. But when you get a breakout mode pattern in a trading range, it's not as meaningful as when you have a breakout mode pattern when the breakout makes more sense, when the context supports it. What I mean by that is, let me see if I can find an example really quick. And I may not be able to here, but this could work. Right here, we have an OO pattern. It's close enough, and that's another breakout mode pattern. And we have maybe 3 or 4 pushes up at the top of a channel. Bears are hoping on a reversal. So you might get a reversal down, but bars above the moving average. The moving average has been support, might just be a minor reversal. It's not a great example, but what I'm trying to explain with today is that even though we have an IOI pattern, what is the market trying to reverse? If anything, it might just be trying to continue the bull channel. There's not much selling pressure through here on the way up, and there's room to the upside. We could test yesterday's high. So not great for looking for any kind of reversal. But overall, when you look at bars 1 through 8, is it a bear trend? Is it a bull trend? No, it's a trading range. We went down, we went up, we have a lot of overlapping bars. So when you get breakout mode patterns like IOIs in trading ranges, they're a little more meaningless. Bar 9, you can see we broke to the downside. We tested near the low of bar 6 and then reversed right back up. So I'd have a breakout, deep pullback, and starting to get a second leg up. 10, we have a bear trend bar. You can call it a bear reversal bar. Micro double top. We went up on 8, down on 9, up on 10, or up on 9 and down on 10. There's a stop order short below 10, but if you sell below 10, you are selling in the middle of a tight trading range, and that's never ideal. Plus, you have a rising moving average. You're in a bull channel. It's counter trend. So low probability, but you can sell for a swing. And then 10, we didn't trigger, or 11, we did not trigger the sell below 10, but we got a bull breakout on bar 11. Strong enough breakout that we'll probably get a second leg up, but we might have 3 pushes up, bar 1, bar 7, and bar 11. Follow through buying on bar 12, but closed well below its midpoint. Not ideal for the bulls, but very little overlap between the bars. You can see as soon as the bar closed on bar 11, traders hit buy the market. There's no tail below 12, and we just rallied. So that is strong enough to expect buyers below and a second leg. Bar 10 was a bad stop order signal bar for the bulls. There probably were not many traders buying above bar 10, but then we got bar 11. And that makes the high of bar 10 support. So what you might have is traders who see this rally from bar 11 to 12. They see that it's strong enough for a second leg, but they don't want to buy up here or up here. They want to buy a pullback and capture a second leg. So they might set a limit order at the high of bar 10, or maybe somewhere down here in the lower half of bar 11, looking to enter on a pullback and capture a second leg up. 13, a strong bear trend bar, but could just be a vacuum test of support. You can see we're testing a little bit below the high of bar 10, and this is still strong enough for a second leg, but a little dangerous because it might be a late leg high in a trading range. Outside bar 14. For me, the bulls have done the minimum. They've tested the high close of bar 12. So if a bull bought the close of 12, scaled in lower, they were able to avoid a loss on their first entry. But bar 13 is disappointing for the bulls, and you can call it a wedge, and this is a decent sell signal bar. Of course, anyone who sold below 13 is trapped, but maybe you use a stop above bar 12 and look to scale in higher. 15, another IOI pattern, this time after 3 pushes up, fairly high in the range. A more credible sell below 15. This IOI is a better signal bar than bar 8. The context is also a little bit better. The bulls have had a couple of attempts to the upside, and we're high in the range, and the bulls are failing. And we're starting to go more sideways. And if this overall is a big trading range, we can come all the way down to yesterday's low. Plus the higher time frame context. This entire sell-off from yesterday's bar 1 to bar 46 was a strong enough breakout for a second leg, and this could all just be a deep pullback before we get a second leg down. And that's easier to see on a higher time frame. For example, here's over here on the right, the 15-minute chart. Here's the sell-off, deep pullback, and then maybe we find sellers at resistance and get a deep pullback and a second leg down. Continuing more sideways, bar 18, we have a contracting triangle. which again just means the market is in breakout mode. And it is possible the market is in a bull trend. All the bars have been above the EMA, and this could be a trend resumption set up for the bulls. There is room to the upside. We could test yesterday's high. But I think overall, with the big down, big up, and all the overlap here, it's more likely that the market is in a trading range, and this bull trend is really just a bull leg in a broad trading range. And I think it's reasonable for bears to start to look to sell for a swing. And for as far as always in goes, it's probably always in long, but getting dangerous because you're getting high in the range and you're getting a lot of overlap. And then you get 19, 20, 21, you're getting consecutive bear bars, 4-bar micro channel, 5-bar, 6 bars. That's a problem for the bulls. 18 through 23, strong enough bear breakout for second leg, sellers above. The first reversal attempt should fail. And then 24, probably a minor reversal and a second leg down likely. Is 25 the second leg? Leg 1, pullback, leg 2? It might be, but I don't think so, because the market likes symmetry. And it's really common to see brief second legs like this, and then deeper pullback, and then asymmetrical second leg. Plus this entire sell-off is a tight channel, and that's a breakout on a higher time frame. 27, we went outside up. I think it's reasonable let me back up. I said it wasn't too clear in here for always in, but I think once you get bar 22, the market is always in short. And it's not always in long here or here, although 27 is reasonable for always in short bears to exit, and then they can look to re-enter. Aggressive bulls can buy above 27, but it's not great because it's a tight channel. There's no meaningful trendline break, and the bar is completely above, or rather below, the EMA. And then we can see the market triggered the buy by one tick and then trapped bulls. So any trader who bought above 27 was immediately trapped on 28. If you bought above 27, how do you feel about your entry bar? Probably disappointed, and you may just look to exit and look to buy again lower. Bear breakout 29. Even though it's a weak close, the breakout is decent. The market fell a decent distance below the prior bar, and there's not much overlap, and this might be a breakout pullback, and traders might sell the close here to capture a second leg down. Plus, this entire sell-off still might just be one leg on a higher time frame chart. Going lower, and you can see the market, we're getting a breakout, a pullback, breakout, pause, pullback, breakout. 33 might be a parabolic wedge, and we might find some profit taking here because of the structure of this breakout. I said it's a parabolic wedge. Parabolic wedges are minor. So if you looked at a smaller time frame chart, you would see the 3 pushes down more clearly, but on this chart it's more inferred. And the point of that is if it's minor and the expectation after a wedge is 10 bars and 2 legs, you might only get 10 bars and 2 legs on the smaller time frame where the wedge is more clear. And that might be less than 10 bars on this time frame, on the 5-minute. Because parabolic wedges are minor and they're actually breakouts on higher time frames, the expectation is that the pullback or the reversal attempt, it typically becomes a pullback and you get trend resumption. Pulling back, probably buyers below 34. It's a bad sell signal. We just had consecutive sell climaxes. Bears might look to take profits down here and look to sell a little bit higher. 36, a second leg up, so leg 1, pause, leg 2. Maybe there's a low 2 short somewhere in this bar. You'll have limit order traders selling the high of 34, betting that this is a minor reversal and the bear trend will continue. At this point, we might have a small pullback bear trend. We have open gaps lots of bear bars. It's fairly orderly, not very climactic. But the bears still have a problem, and that is all the bars to the left. Even though this is pretty decent selling, you look to the left, and it's the same problem the bulls had up here when you look to the left over here. Big down, big up. And then over here, it's big up, big down. So even though this is fairly strong, and this is probably a minor reversal, the downside still might be limited. Low too short below 37, but 36 might be strong enough for buyers below and a second leg up. And that's what we got on 38. So it looks like 36, we had a 50% pullback of the bar and then got another rally. Now we have 3 pushes up, might be a wedge bear flag. Some traders will sell below 38 on a stop, looking for trend resumption. It is a sell reversal bar, even though it's a bull close. The bar closed below its midpoint. 39, that looks like it did not trigger the sell below 38. So 39 becomes the signal bar for the bears. 40, pretty decent entry bar, and the bears want continuation. And then 41, not great for the bears. There's a lot of overlap. The bar is getting smaller, the body's getting smaller, and now we have a lot of bars sideways. There might be support down here. It's still more likely we break to the downside because of what came before this trading range. 42, a bull bar. Now we have a double bottom. I think 42, it's reasonable for bears to exit above 42. And it's not necessarily an always-in flip, but it's a credible place for bears to exit and look to sell again higher. 43, a little bit of a surprise bar. It's a good bull trend bar. Is it always in long? I don't know. It might be, or it might be a near flip. And near flips are really common when the market might be close to becoming always in long, but you're not quite convinced, and maybe you need one more bar to convince you. Here's the bear trend line. We're getting one bar breaking above it, but we still need follow through. Plus, this looks like a minor reversal. I drew this major trend line because for a major trend reversal, you need you prefer a strong break of a meaningful trend line and then a retest of the trend's extreme, and only then you can look for a major trend reversal. But here, we only have one bar breaking this trend line, and this is not that many bars, and we just have one bar closing above the EMA, which is the first bar to do that in about 20 bars. So the odds are there are sellers here. Plus, if you think about the market cycle, spike, pullback, channel, trading range, market's testing the top of a trading range, and there was a bear trend before this trading range. So the odds are higher that this trading range will be a bear flag. There's a higher probability we get the downside breakout. And then just one more thing, the rally from 33 to 38 might be leg 1, even though it's subdivided into 3 pushes. Then we got a pullback, and maybe this is leg 2, and that might be a second leg trap in a trading range, and it's counter trend. So whenever you need one more bar to convince you that the market has flipped to always in long, it's really common for traders to actually take the opposite side of that trade. So if the bulls need one more bar, bears know they need one more bar, and they'll sell to try to prevent the bulls from getting that one more bar. And you can see what we got on 44. Traders sold the close of 43, and we sold off. Now, 44, it's a good-looking bear bar, but it's overlapping all of these bars. And now we're at the bottom of a trading range. It's strong enough that we'll probably go at least a little bit lower, but this is enough sideways to create confusion and disappointment for the bears. So we're going sideways to down. Maybe we have a small spike in channel, bear trend, with a couple of legs. Might be buyers below. This is disappointing follow-through for the bears. Anyone who sold the close of 44 is hoping for momentum and continuation to the downside, but instead we're going sideways. And that might make the premise of the trader who sold here invalid, and they may look to buy back their shorts and look to sell higher. 42, 43 was strong enough for a second leg, and if this is the trading range, we could simply get a deep pullback and then a delayed second leg. Continuing down on bar 50, and we have the strongest bear bar in, it's not the biggest bar, but it opened on its high, closed on its low, and that's a warning of climactic behavior. And then, like I mentioned, this could be a small spike in channel, bear trend, and we're getting a breakout of a channel line right here. And so there actually might be more buyers on the close of 50, bears taking profits, maybe aggressive bulls buying, betting that we have evolved into a trading range. 51, a good bull bar. Another one of those situations like 27 or 42, where if you're an always in bear, you can exit above 51 and look to sell again higher. And bulls, I mentioned this probably is not enough for a major trend reversal, but 43 should get a second leg. This might be a trading range at this point because the market went above bar 32, and that was a major lower high. It's not great. It's not as major as up here on 28, but we did go above this lower high, and that's enough to convert the market into a trading range or a bull trend. Rallying above 51, pretty good follow through for the bulls, but big down, big up. So even though it's a decent micro channel, just look to the left. What happened on bar 43? Any trader who bought 43, let's say you bought the close of 43, you suffered major disappointment on 44. So if you used a wide stop and scaled in, what are you going to do if the market gets back to this red line? You might look to take profits on your longs. You might look to sell out of your long and look to just break even on the trade. And that's exactly what happened on 55. So for 55, I'm not sure the market ever became always in long through here. And even if it did, you're high in a trading range or in a bear channel. And that means the market might still be always in short. If that's the case, then bears can re-enter below 55. Getting follow through for the bears, it's not great, but it's also not good for the bulls. Now for the bulls, 51 through 54 or 55 should get a pullback and a second leg up, and maybe we are around 50%. Maybe just the bull bars, here's 50%. But you can see we're actually getting below 50%, and it's counter to the direction of the trend. So it's not great for the bulls here. More likely, buyers will come in below 51, just like over here. Bulls did not buy up here, but they did buy below 42. I can back up on that. If a bull did buy below 42, and that's their entry bar, they might just exit at break even. That's what they did here. It's the same idea here. Bulls might just buy below the breakout rather than up here at resistance. 60, sell climax. It's one of the biggest and strongest bars of the bear trend. Might be 3 legs down, 1, 2, 3. We're testing the channel line, which is expected to be support. And look over here at bar 47 yesterday. Bad stop order signal bar. The bar closed below its midpoint, but had a great entry bar, and then we rallied for a lot of points. The high of bar 47 is expected to be support for that reason. Not a credible stop order buy. You have trapped traders. When the market retests this horizontal red line, the odds are there will be buyers here. 61, we fell below that support level, but we did close above it. 61, breaking out below this bear channel line. It's a low probability event. 25% chance we get a successful breakout of a bear channel line. 75% chance you get a failed breakout and the market retests the trend line, reverses within 5 bars, and then retests the trend line. Here's the trend line above. This is the channel line below. Bad follow through, big tail below 61, inside bar, and big tail below 62, and then 63, a bull bar closing near its high. Another situation where always in bears can exit above 63 and bulls can buy if they're aggressive. Good entry bar 64, probably going at least a little bit higher. A pause, so we have a buy climax, a pause. 66, another buy climax. We tested the bear trend line. We tested the close of 54, another pause. So we have a buy climax, a pause, buy climax, pause. Maybe we get one more buy climax, but even if we do, the upside is probably limited. You can see at this level, we're finding resistance. Here, we sold off, we come back and test it, we sell off, we come back and test it. The odds are there's sellers here. High 167, but it's a doji, it's an inside bar, probably sellers above. And then more sideways, so we had a buy climax, a pause, a buy climax, a longer pause, and think about a bull. If you bought the close of 66 and you sat through this pullback, 70 gave you a chance to exit at break even, and it looks like that's what bulls are doing. Second reversal below 70, maybe you wait for a bear bar, 71. Maybe you sell below here, looking for a test down. Because just like 47 yesterday, bad stop order buy signal bar, it's the same deal with 62 today. So down here is a likely magnet. It's a target. It's a test target, and it's probably support. So you can sell up here, look to get out down here. Going mostly sideways, and the more we go sideways, the worse it gets for the bulls, because if you're buying, where's your stop for the bulls? It's a micro channel all the way to up here. And if you're buying the close of 66, your 1-to-1 of your risk reward is all the way up here. And if you're taking a trade with 1-to-1 risk reward, you need to be at least 60% certain that the market is going to your target before it goes to your stop. And when you're getting buy climaxes with pauses and you look to the left and you're still below bars, it's really not ideal. It's probably not 60%. And then you start going sideways, and all of a sudden the momentum is gone, and there's no way it's 60% that we're going up there before down here. It's 50% at best, and you cannot take a 1-to-1 trade with a 50% probability. You will lose money. That is not a positive trader's equation. The minimum win rate for 1-to-1 is 60%. And when you factor in human error and mistakes and slippage and commissions, 60% is really break even with 1-to-1. Bear bar closing on its low, follow through. Breakout and follow through, probably going to go at least a little bit lower, but we'll probably pull back first. We're testing the low of 72, which was support. We went a little bit lower, outside up, 77. Lots of overlap, very deep pullback, but 74 through 76 should get a second leg down. And then right back down, 78. We tested the bad stop order, and we went sideways there. For stop order trades today, I think it's reasonable to buy above bar 6, but small signal bar. And if you do buy above bar 6 and you have a stop below 6, you obviously would have been trapped out. And if you're buying above 6, maybe for a swing, you might put your stop below 77 or 73 yesterday. Up here, not really great. There's an argument to be made selling below 15. It's a swing sell. Not the worst trade in the world. Or you could wait for higher probability. You start to get the bear breakout, and maybe you sell after you see 22. It's always in short. We're high in a trading range. And when I say we're high in a trading range, I mean over here with yesterday. Always in short, you can sell below any bear bar. Here's a decent sell below 28. You can sell below 30, 32. Through here, not great for stop orders. There might be a buy for a scalp above 42, but that's a counter trend scalp and not an ideal trade. And then 51 you could buy, but again, not ideal. Not really a major trend reversal setup. I thought 55 was reasonable to sell. Down here, nothing really ideal. 63 you could buy, maybe buy the close 64, but the upside, the upside is limited, and you might just scalp out here. You could sell below 68, and you could bet that it's 2 legs up in a trading range, but this is fairly tight. You might wait for more sideways before you start to sell, and then maybe you sell here instead below 74. It's a good signal bar. The market went sideways. Maybe it's an endless pullback. The bulls are hoping it's a rally, pullback, second leg, but there's a bear trend line. And that's about it for stop orders. The day type today, we had a bear channel. The market was making lower highs and lower lows. It's a bear trend, but it's not very strong. You could also call it a bear trading range day. And if you look at the majority of the day, if you look at this snippet, you would call it a trading range. And if you look down here, you would call this a trading range. And so the market did go down over time, but it was really a trading range for the majority of the day. Where do we go Monday? I keep talking about the moving average, the potential for a vacuum test of the moving average, and that's what I'm thinking here. We have a couple of legs up, but we're high in a trading range, tight trading range here. We tried to break out to the upside. We're failing. And again, if a bull is buying all the way up here above the average price, and this is the price action that they're getting, then they're paying far above average price for average price action. And at some point, they'll stop buying, and we could easily get sucked down to support. And that might be all the way at the moving average down here. It could be down here. Maybe we have a spike, pullback. Let me just turn on the Globex chart, extended hours. There's less gaps. So maybe we have a spike in channel, and the start of the channel here will be support, and maybe we get vacuumed down to there. You can see the market might be a complex top, consecutive buy climaxes, maybe 3 pushes up, and then 3 pushes up in here, 1, 2, 3. Bear, reversal bar, closing on slow. I think the risk is real that we could trigger the stop order and fall down here before we go back up here. And then just one more thing. If anyone watched my last video, you'll remember at the end I touched on the importance of having a trading plan or a system to follow. So I wanted to talk a little bit about that and clear up some confusion that I think a lot of people have. And when I say that, I'm really speaking from my own experience. So I'm really talking to someone, or it's almost like I'm talking to my younger self. And I'm hoping that somebody who is watching this can relate and apply what I've learned and save themselves years of struggle. What I've found is if somebody wanted to learn how to trade using Al's methods and I mean a complete beginner. And if they wanted to only focus on the most important things, and if their goal is to make money, then they would focus on breakouts and they would focus on always in. And you can fact check me on this, but I believe in the chapter on breakouts in Al's trend book, he says that breakouts are at the heart of everything that traders do. And in the always in chapter, in his reversals book, he says always in might be the single most important concept that a trader can understand. I will mention that it does help to know other things like the market cycle, leg counting, everything else in between. Those things can help, but if the goal is to make money, you don't have to know everything that Al knows, or that Brad knows, or that even I know. If your goal is to make money, focus on what Al considers the most important things. If you read carefully about what he says in those sections, you'll find that you can skip every other chapter and learn how to trade with those two concepts alone. And also, before I go on, how do I know that he says those things in those exact sections of those books? Because I've gone back to them and read them over and over again. Repetition is key for learning anything, but repetition can also be detrimental if you're just repeating harmful habits instead of positive ones. So I'm convinced that anybody could learn how to trade in less than a year if they only studied those two chapters and those sections in the video course. So with those two concepts in mind, anybody could build a profitable system in realistically just a couple of months if they only focused on breakouts and always in. I know that may sound crazy, and you may think my perspective is warped because I've been studying Al for a number of years and I've had time to internalize a lot of things, but I've seen it happen, and I'll explain why I'm saying what I'm saying and why I truly believe it. And by the way, I am not the trader who became profitable in less than a year, but I do know someone who has. I've been studying Al Brooks for 5 years, and I'm only just now beginning to see consistency. The reason for that is because I've started to focus on system development and the execution of the system that I'm developing. When I was fairly new to trading, maybe after a year or so, I actually tried to develop a trading system with a friend, and we found that it didn't work, and I speak for myself when I say I concluded that a simple trading system could never work, and I figured that that wasn't the way to do it. And I thought that if I just studied Al for long enough and got really good at reading price charts, that alone would develop into profitable trading. But the problem is that chart reading and trading are two different but equally challenging skills. You could read a chart like Al Brooks, but still not be able to trade successfully. And likewise, you can read charts worse than Al Brooks and trade very well. How is this possible? Because chart reading is only half of the equation. So again, I'll speak briefly about myself. I spent the majority of my years studying Al on my ability to read charts, and you can see it reflected here. I have confidence in speaking through charts bar by bar, but the problem that I've had is if you go into each day without a plan and your idea is to just watch the market and just rely on your chart reading and trade on the fly, you're going to have a really hard time finding consistency. You're going to struggle with trusting yourself. You're going to struggle with knowing what trades you like and don't like, what trades are working well and aren't working so well. And I get it. Everyone wants to be like Al, and everyone wants to be able to just look at a chart and start trading wherever the market is in the current moment. But the problem is that Al has 40 years of experience, and he didn't start as the discretionary trader that he is now. I remember I heard in an interview a few years ago, and I can't even find it anymore, but I've heard that Al's first system was something like waiting for a breakout of the prior day's high or the prior day's low and fading the breakout. Or, in other words, entering on a reversal, betting that the breakout would fail. And the point is that Al did not start as a discretionary trader who traded based on his emotions and his experience alone. Al has a collection of systems in his mind, and he can fall back on any one of them and trust that he'll be profitable if he trades them. You hear his systems when he talks through charts in the trading course, or if you've ever listened to him live in the webinar. But he can only be confident in his ability to trade because he's back-tested systems, and he's forward-tested systems. He's proven to himself that he has the discipline to follow the systems he's built, and he knows that if he executes well, he will make money over time. Remember, nobody knows if they're going to win any one trade. Nothing is 100% in trading. Nothing is 100% in anything. But you can get to a point where you win more than 60% of your trades. But I don't believe it's possible to get there without building trading systems. Or if it is, it takes a lot longer to do it that way. And what I'm getting at with all of this is I urge everyone to try to build trading systems and start slow. Just build one system. And it can be the worst system in the world. Just pick one thing to focus on and stick with it. Breakouts and second legs, always in. And just execute it well. And don't associate your performance with your profit or your loss on that one trade or on that one day, but rather judge your performance based on how well you executed the system. I don't care if your system has a win rate of 20% and you lose money every day. If you're trading the system and following your rules, you can pat yourself on the back. A friend of mine recently talked about the importance of the process over the importance of the outcome. Like I said, nobody knows if they're going to win their next trade. Nobody can control that. But you can control your execution and you can trust your statistics. The magic comes from following a system because at that point, the market shows you the inefficiencies of the system. So you might notice, hey, every time I take this trade, I sit through a pullback. And that information alone tells you your entry could be more efficient if you enter somewhere else instead of what you have been doing. And I don't want to ramble too long about this, but I just wanted to express how important I think it is for a trader to develop their chart reading as well as develop a trading system that they can follow and that they feel comfortable trading. I'm hoping you don't make the same mistakes as me, and I hope I'm being clear when I say that chart reading and trading are two different skills. Your ability to read charts alone cannot make you rich. There's a reason institutions hire analysts to give advice to their traders, but those analysts aren't traders themselves. So the main takeaways from this conversation are, I would say, focus on the most important things, build one system, keep it simple, and practice executing well. And if you do those things, you will see improvements faster than you would believe is possible. And it sounds simple, but that doesn't mean it's easy. All right, that's all the time I have for today. Thanks everybody for watching, and I hope everyone has a good weekend.